Two things happened in the same week that on paper should have nothing to do with each other. Japan spent more money defending its own currency in a single day than it ever has in history. And on the other side of the world, South Korea's stock market had the single worst month in its entire recorded history, worse than the 2008 financial crisis, worse than the 1997 Asian crisis that nearly took the country down. Most coverage of this week either treats those as two unrelated headlines or jams them together into one giant conspiracy and calls it the machine. Neither of those is actually right. The real answer is more interesting than both. They're related, but not in the way you'd assume, and untangling that is exactly what's going to make you smarter about markets than almost everyone else talking about this right now. I'm May, this is Behind the Market, and today we're pulling apart a story that most finance content is either oversimplifying into a single scary narrative or missing entirely the common assumption and why it's half right. Here's the assumption you'll see everywhere right now. Japan's currency crisis caused Korea's stock market to collapse, and both are the first cracks in one giant hidden system finally breaking. It sounds compelling. It's also not quite what happened. Here's the more accurate, and honestly more useful version. There genuinely is a hidden mechanism connecting Japan's currency to global markets, and it's real, and it's worth understanding deeply. But Korea's crash had its own separate trigger. Two real stories, running in parallel, occasionally touching each other. Let's take them one at a time, starting with what actually happened in Tokyo and Washington. Point 1. The intervention that actually happened. On Thursday, July 30th, Japan spent an estimated $53 to $59 billion in a single day buying up its own currency, the largest one-day intervention on record. The yen had been sliding toward 164 to the dollar, a level not seen since 1986, and Tokyo had clearly decided enough was enough. Then came the but that makes this actually newsworthy instead of routine. The next day, Friday, July 31st, the U.S. Treasury joined in, something Washington hadn't done since 2011. And even that was a natural disaster response, not a market intervention. This time, the New York Fed sold euros and bought yen on the Treasury's behalf, executed through Goldman Sachs and Morgan Stanley, and in a detail that made this story genuinely go viral for good reason, not a manufactured one. Reuters photographed Treasury Secretary Scott Bessent's own notepad during a cabinet meeting that weekend. It read, "To do buy Japanese yen, $5 to $10 billion. Bessent had also publicly called the yen very undervalued days earlier. So why would the US government spend real money defending a foreign currency? Here's the mechanism, and it's the actual reason this story matters to you. Japan is the largest foreign holder of US government debt on the planet, north of $1 trillion in treasury bonds. When Japan needs dollars to defend its currency, it has a tool called the FEMA repo facility that lets it raise dollar liquidity by borrowing against those treasuries instead of selling them outright. That softens the blow, but if this drags on, the pressure to actually sell into the open market doesn't vanish, it just gets delayed. And when a holder that large sells, or even might sell, Treasury yields move. Right now, the 10-year is sitting close to 4.7%, and the 30-year just touched its highest level in almost 19 years. Those yields are the base ingredients for your mortgage rate, your auto loan, your credit card APR. That's the real verified thread linking a currency intervention in Tokyo to your own bills. No exaggeration required. Point 2. The trade that makes all of this possible. Now here's the part that actually deserves the dramatic music, because it's real, and most people genuinely have never had it explained clearly. It's called the carry trade, and it's been quietly running under the financial system for years. Here's the plain version. For a long time, Japan kept interest rates near zero. That means big funds could borrow yen for almost nothing. Step 2. They'd convert that yen into dollars. Step 3, they'd take those dollars and buy higher-yielding assets, US stocks, US bonds, pocketing the difference between what they paid to borrow and what they earned investing. Borrow cheap, invest for more, keep the spread. It's been one of the most reliable trades in modern finance, for one reason. It only works cleanly while the yen stays weak and cheap to borrow. Here's the but. The moment the yen gets meaningfully stronger, the loan you took out gets more expensive to pay back. You borrowed yen, and you eventually have to repay yen. A cheap loan can turn into an expensive one fast, and when that happens at scale, funds with the least room to absorb the loss start unwinding those trades, selling the US they bought to raise cash and cover the now pricier yen loan. That's a real phenomenon, well documented by economists and traders, and it's exactly the kind of thing that can add sudden, sharp volatility to markets that otherwise look calm on the surface. This is genuinely one of the more underappreciated mechanisms in global finance, not because anyone's hiding it, but because interest rate differential between two countries doesn't naturally make for a gripping headline. It should. It's been quietly supporting asset prices for over a decade. So that's the real, verified mechanism behind Japan's intervention, and it's a legitimate thing to watch closely. But here's where I need to correct something almost every piece of coverage on this got wrong this week, including the loudest voices calling this one giant machine. Korea's crash was not primarily this story, and understanding why is actually more useful to you than the version that sounds scarier. Point 3. What actually crashed South Korea's market? South Korea's Kospi index had its worst month in its entire history in July, falling roughly 23 to 35% from its June peak, depending on how you measure the drawdown, and triggering multiple market-wide circuit breakers, including back-to-back trading halts on consecutive days for the first time in the exchange's history. Samsung Electronics and SK Hynix, the two companies that dominate the index's weight, both posted repeated double-digit daily declines during the worst stretches. Here's the detail that should genuinely surprise you, because it's the opposite of what you'd expect from a currency contagion story. SK Hynix reported its most profitable quarter in company history in late July, a record beat on earnings, and its stock still fell nearly 10% that same day. That's not what a currency panic looks like. That's a market that had priced in even more explosive AI-driven chip demand than reality delivered, suddenly reassessing whether the entire AI semiconductor boom had run ahead of itself. The Kospi had rocketed up on almost limitless AI enthusiasm through the first half of the year. July was the moment that enthusiasm cracked under its own weight. Was the yen story a factor at all? Almost certainly around the edges. Global risk sentiment doesn't stay neatly contained in one country, and a currency intervention adds to a general sense of unease that can make investors more willing to sell elsewhere too. But the proximate cause, the thing that actually triggered the selling, was a semiconductor-specific reckoning, not the yen. Treating them as one unified crisis makes for a punchier video. It's just not the accurate one, and understanding the real, separate cause of Korea's crash tells you something more useful. This wasn't a currency contagion spreading country to country. It was a sector-specific valuation correction that happened to land in the same news cycle as a currency story. So why does any of this matter if it's not one big unified collapse? Because both stories, independently, are pointing at the same underlying question for markets everywhere right now. And it's a question worth sitting with. Point 4. The question both stories are asking, here it is. How much of what's propping up asset prices right now is genuine value, and how much is leverage that assumes conditions stay exactly as they are? In Japan's case, that's leverage built on the assumption the yen stays cheap. In Korea's case, it was a valuation built on the assumption AI chip demand growth would keep accelerating indefinitely, until a company posting record profits still wasn't enough to satisfy that assumption. Different mechanisms, same underlying fragility, prices that depend on a trend never pausing, and this connects to something much closer to home. America's largest technology companies are currently running the biggest corporate borrowing spree in modern history to fund AI infrastructure. Well over $100 billion in bonds issued by the 5 biggest players in just the first half of this year alone, priced off the same Treasury yield curve that Japan's intervention and the Fed's recent hawkish tilt are both pushing upward. Higher yields don't just raise your mortgage rate, they raise the cost of the debt, funding a meaningful share of expected US economic growth. Korea just showed what happens when a market built on an assumption of endless AI growth meets a reality check. That's worth remembering the next time a hyperscaler's earnings call talks about capital expenditure guidance, bringing it together. So here's the accurate shape of this week, not the sensationalized one. Japan and the US carried out a real historic joint currency intervention, rooted in a genuine and underappreciated mechanism, the carry trade, that's worth understanding regardless of what happens next. Separately, Korea's market had a real historic crash, rooted in a semiconductor-specific reassessment of AI demand, not a currency contagion. Both are legitimate stories about leverage and assumptions meeting reality. Neither needed an invented trillion-dollar 40-minute plot twist to be worth your attention. The real versions were compelling enough on their own. If you want the story explained accurately, instead of dramatized past what actually happened, that's what this channel is for. Hit subscribe if that's useful to you. What to actually watch? You don't need to predict the yen's next move or time Korea's chip cycle. What's actually worth watching is simpler: the 10-year and 30-year Treasury yield, since that's the thread connecting Japan's intervention, the Fed's current stance, and the cost of the AI build-out all at once. And if you hold any concentrated bet on a single sector, a single trade, a single assumption that conditions stay as they are, Korea's July is a real-world reminder of what happens when that assumption gets tested. This isn't financial advice, it's the mechanism worth understanding before you make a decision that depends on it. Most explainers this week gave you one version: a single hidden machine, $1 trillion gone in minutes, beginners doomed unless they act now. The real story was two separate verifiable events that both happen to be asking the same question about leverage and assumptions. That version doesn't need to manufacture urgency. It's genuinely useful on its own. If you want more of this, the real mechanism minus the theatrics, subscribe, and I'll see you in the next one.